Imagine two people. Same age, same job, same paycheck. They wake up in the same suburb, drive the same kind of car, drink the same burnt office coffee every morning. From the outside, their lives look perfectly synchronized. But 30 years from now, one of them will be $250,000 poorer than the other. Not because of bad decisions, not because of gambling, drugs, or financial stupidity, but because of a number. A number neither of them chose. A number neither of them truly understands. A number that quietly decides how expensive life is allowed to be. This isn't a story about income. It's not even a story about debt. It's the story of the credit tax, an invisible toll booth placed on every major decision you make in America. Housing, transportation, insurance, employment. You pass through it whether you notice or not, and the price is brutal. If your number is high, the gate opens and money flows cheaply toward you. If it's low, the gate still opens. But everything costs more. Same life, same purchases, same mistakes. Different price tag. Most people think a credit score measures responsibility. Some think it measures morality. Others think it's a reward for being good with money. That's the lie. A credit score doesn't measure how safe you are. It measures how profitable you are. It answers one question only. How much interest can we extract from this person before they break? And in today's high-rate environment, that question has never mattered more. A small difference on paper becomes massive over time. One extra percentage point here. Another half point there. It doesn't feel dangerous. It feels normal until you zoom out. Until you add it up and realize that your future retirement, your investment capital, your freedom, has been slowly siphoned away by an algorithm written decades ago. This system isn't ancient. It isn't natural. It isn't inevitable. It was built. And like everything that's built, it was built for someone. In this video, we're going to break down where this system came from, how it quietly punishes the financially organized poor, and why the difference between good and excellent credit can cost you more than a house. Not to scare you, not to shame you, but to remove the blindfold. Because once you see the game, you stop paying the extra fee for existing. And that's where the real money is. Let's stop speaking in metaphors and start speaking in math. Because this is where the illusion collapses. The largest financial decision most people will ever make isn't a car. It isn't college, it's a house. So let's take a very ordinary number, a $400,000 home. Nothing fancy. Just drywall, wiring, and a patch of grass. Now picture two buyers standing at the same bank counter. Buyer A has an excellent credit score. Buyer B has a fair one. Not bad, not reckless, just not elite. The bank doesn't reject buyer B, that would be stupid. There's money to be made. Instead, they adjust the price. Buyer A gets the advertised rate. Buyer B gets the risk-adjusted rate. On paper, it looks harmless, a difference of around 1 to 1.5%. Most people shrug and sign. But stretch that difference across a 30-year mortgage and something ugly happens. That small percentage gap quietly inflates into 6 figures, not overcharging for luxury, not a penalty for bad behavior, just interest. Same house, same loan length, same economy. One person pays roughly $120,000 more for the privilege of borrowing. And here's the part nobody tells you, that $120,000 doesn't just disappear. It doesn't evaporate into thin air. It's money you never get to invest. If that cash had gone into even a boring index fund over those same 30 years, it could have grown into several $100,000. Which means the real cost of a lower credit score isn't just interest. It's the future wealth you never get the chance to build. This is how the system compounds inequality without ever mentioning the word. But the mortgage is just the opening act. Because the credit score doesn't stop at lending anymore. It escaped the bank, it leaked into everything. Car insurance companies started using it. Not your driving history, not your accident record, your credit score. They decided that people with lower scores are statistically more likely to file claims, so they charge them more, even if they've never crashed a car in their life. In some cases, a safe driver with bad credit pays more than a reckless driver with perfect credit. Let that sit for a second. The system trusts someone who wrapped their car around a pole more than someone who paid a bill late during a crisis. That's not risk management, that's a poverty surcharge. Landlords use it. Utility companies use it for deposits. Employers quietly check it in certain industries. Your credit score has turned into a background hum behind your entire life. You don't hear it directly, you just feel the friction. Applications denied, deposits inflated, rates nudged upward, death by 1,000 invisible fees. And the most unsettling part is this: the score doesn't actually measure how much money you have. You could have hundreds of thousands in savings and still be considered thin file or unscorable. To the system, you barely exist. But someone living paycheck to paycheck, juggling debt perfectly, looks responsible. The algorithm doesn't reward stability. It rewards participation. It wants you borrowing. It wants you revolving balances. It wants you paying interest forever, which is why the game feels rigged, because it is. And in the next section, we're going to open the black box and look at how this number is actually calculated and why some behaviors that feel smart are quietly punished. Now let's open the machine. Because once you understand how this score is built, you stop blaming yourself and start seeing the incentives. A credit score isn't mysterious, it's mechanical. It's not asking, is this person wealthy? It's asking, is this person predictable and profitable? The largest piece of the score is payment history. Did you pay on time or not? There's no nuance here, no context, no explanation box. A medical emergency doesn't matter. A layoff doesn't matter. One missed payment can stain your record for years. That's roughly a third of the entire score. But the second biggest piece is where the game reveals itself: credit utilization. This is the ratio between how much credit you have and how much you're using. Spend half your limit and the system gets nervous. It reads urgency. It reads stress. But here's the twist. You can lower utilization without paying off a single dollar. If your limit is small, the same spending looks reckless. If your limit is large, it looks disciplined. Same behavior, different optics. The score isn't measuring responsibility. It's measuring how relaxed you appear while borrowing, which is why people with access to massive credit lines are treated like royalty even if they carry balances. Then there's length of history. The system favors age, not wisdom, just time. Close an old account and your score can drop. Not because you did something risky, but because you erased evidence of long-term participation. It's like being punished for graduating. And then there's the most revealing moment of all: paying off debt early. You'd think this would be celebrated. It isn't. Many people pay off a car loan and watch their score fall. That's the algorithm speaking plainly. You stopped being useful. You stopped generating interest, so your value dropped. This isn't a score of financial health. It's a customer loyalty program. It rewards people who stay in the cycle. It penalizes people who exit it too cleanly. And this is where inequality quietly reproduces itself, because families with strong credit can pass it down. Parents add their children as authorized users. The child never touches the card, never borrows a dollar, but inherits decades of perfect history. They start adult life with VIP access. Meanwhile, someone without that safety net starts at zero, or worse. They pay higher rates, which makes mistakes more expensive, which damages their score further. The system doesn't forgive. It snowballs. And when something does go wrong, an entire industry appears. Credit repair. Most of it is smoke and mirrors, but the trick they use is real. The law requires that every mark on your report be accurate and verifiable. If it isn't, it can be removed. Not because the debt didn't exist, but because the paperwork failed. The wealthy exploit legal loopholes constantly. Taxes, contracts, corporations. This is the same game, just at a smaller scale. So the question isn't whether the credit score is fair, it's whether you understand that fairness was never the goal. And in the next section, we'll talk about the only practical response. Not rebellion, not avoidance, manipulation. At some point, every rational person reaches the same conclusion. You can't opt out of this system, but you can stop treating it like it's honest. Living with no credit score in modern America isn't moral superiority. It's unnecessary friction. Higher deposits, denied applications, extra explanations at every checkpoint. So the move isn't to boycott the game, it's to finish it as fast and as cheaply as possible. Think of your credit score like a poorly designed video game. The controls are clunky. The rules are unintuitive. But once you know how the engine works, you stop button mashing and start speedrunning. The first rule is simple. Never miss a payment. Not because it's virtuous, because it's catastrophic if you don't. One late payment can linger for 7 years. 7 years of higher prices for one moment of forgetfulness. So you automate. Every account, every bill. Minimum payments on autopay. This isn't how you pay debt down. This is your safety net. You can always pay more manually, but you never let the system mark you as unreliable. Second rule, expand the denominator. Every few months, ask for credit limit increases. Most of the time, it doesn't even trigger a hard inquiry. You're not asking for permission to spend more. You're asking to look calmer while spending the same. A larger available limit turns normal life expenses into responsible usage in the algorithm's eyes. Third rule, never kill your oldest accounts. That dusty card you opened in college isn't useless. It's a time capsule. It anchors your history. Closing it erases proof that you've been playing the game for years. Use it once in a while. Keep it alive. Length matters more than activity. And here's the mindset shift most people miss. You are not trying to be debt-free on paper. You are trying to be cheap to lend to. Those are different goals. Being debt-free is about peace. Being cheap is about leverage. You can pursue both, but not at the same time. This phase is about leverage, because when you control the score, everything downstream becomes cheaper. Housing, transportation, insurance. Your life stops leaking money, and once you've extracted the benefits, once you've locked in low rates and flexible terms, you can slowly unwind. Pay things off. Simplify. But you don't do it blindly, you do it on your terms. In the final section, we're going to zoom out and talk about what this system actually rewards and how to protect yourself without tying your identity to a number. This is where people get twisted up. They start believing the score says something about who they are, about discipline, about worth, about intelligence. That belief is expensive because the credit score doesn't care about your goals. It doesn't care about your stress level. It doesn't care about your values. It only cares about patterns, consistency, predictability, compliance. The system is designed to extract wealth from people who are disorganized and reward those who understand the rules, not the smartest, not the hardest working, the most organized. That's why two people with the same income can live in completely different financial realities. One pays list price for money, the other gets a discount, and the difference compounds quietly. The real danger isn't a low score, it's emotional attachment to it. Fear causes mistakes. Overchecking, panic payments, closing accounts out of anxiety. The algorithm interprets emotion as instability. The people who win this game treat the score like a utility meter. They glance at it, they maintain it, they don't worship it. They also understand something subtle. Errors are common. Roughly 1 in 5 credit reports contains a mistake. Wrong dates, duplicate accounts, debts that should have aged off. Every error is an unearned penalty. Disputing isn't cheating, it's maintenance. If the system demands perfection from you, it should meet the same standard. The wealthy do this reflexively, not out of anger, out of efficiency. And once your score is solid, something interesting happens. You stop thinking about it. The rates improve. The approvals come faster. The friction disappears. That's the real win, not bragging rights. Not an 800 screenshot. Silence. Fewer fees, lower interest, more options. The number fades into the background where it belongs. Because the goal was never the score, the goal was to stop paying the invisible tax. And in the final moments, we're going to pull the camera all the way back and talk about the only attitude that keeps you from being exploited for the next 30 years. Here's the truth most people never hear. The credit system isn't evil. It's indifferent. It doesn't wake up trying to hurt you. It simply rewards what it was built to reward. Order, predictability, Participation. If you don't understand it, you subsidize it. If you do, you become expensive to exploit. That's the dividing line. The goal is not perfection. The goal is control. You protect your score aggressively not because you crave approval, but because you refuse to overpay for the same life. You keep utilization low, you automate payments, you preserve history, you challenge errors, not once. Continuously. This is boring work. That's why it's powerful. Banks make their money from chaos. Late fees, confusion, urgency. Organization starves them. And once you've reached the tier where money becomes cheap, you lock in what matters. A good mortgage, reasonable insurance, flexibility. Then you slowly step back. You simplify. You reduce debt. You invest. The score stays high in the background while your life moves forward. That's the exit. Not rebellion, not rage, mastery. Because the biggest lie was never the number itself. It was the idea that you deserve to pay more. You don't. And the moment you stop accepting that premise, the system loses its grip. If this made you realize you've been paying a premium without knowing why, share it with someone you care about. The most expensive ignorance is the kind you don't know you have. I'll see you next time.